Please welcome to the stage Adam Balkin, Sheila Narayan, Max Valverde, and John Harthorn.
Hello. Thank you guys all for coming out on a rainy weekend. We are here to talk about types of funding for startups. So this is a pretty popular topic, can be controversial at times. We're going to have, I think, a really fun conversation. We have a great diverse panel that represents all different types of funding. Typically, I would say when people think of startup funding, they think right away of venture funding, kind of institutional style funding. And that is a great source of funding for certain types of startups and not appropriate for all types of startups. So we're going to try to cover the gamut of all of the different types of startup funding, including venture investing as one of those. I'm going to quickly start by letting in a minute by letting all the panelists introduce themselves quickly. But let me first just list off some of the different types of startup funding that we will discuss, because I think that will help to provide context for us here. So I'm going to start with kind of the least expensive type of funding, first, and then work my way up towards the more institutional style. So the one way to fund your startup is just what is commonly referred to as friends, family, and fools, right? And that is the people that are willing to give you money on really friendly terms up front, typically not a huge amount of money, but very generous funding terms. You often don't even have to pay it back. Or have a real contract in place for it. That's a great way. Then there's just bootstrapping your startup, which is kind of funding it through revenue. And revenue is really the best form of funding in many ways, because it doesn't cost you any equity, and it comes with customers and insights. They help you to identify which products are optimal, et cetera. So we'll talk about that. There's also newly emerging types of funding like crowdfunding and crowd investment platforms. There are startup accelerators, which we'll talk about as well as another source of funding. Then angel investments, and there's a couple of different flavors and varieties there, angel syndicates and groups and individual angel investors, and then venture investment, which is the more commonly known type of startup investment. And then there's a few others out there in another category, like debt funding, or more recently emerging trends using blockchain technology and ICOs, which is pretty interesting. So we'll try to cover those as well. And then we'll open it up for questions. I understand that the acoustics are not optimal for questions, so you're going to have to bear with us as we sort of translate that noise into a proper question and try to address it for you. But let me turn it over to my panelists and let them introduce themselves and give just a quick minute or two on their background and their area of expertise. And why don't we start here with Max Valverde.
Cool. Thanks, everyone, for coming out. My name is Max Valverde, President and COO of Fair Harbor. I'm in that first category of largely bootstrapped, took a little bit of money from friends and family. We are now, to give you some background on what Fair Harbor is, we are the largest online reservation tool for the tour and activity industry. So in travel, there's airline, hotel, and activities and attractions. We're the largest software provider for those attractions. Think whale watches, walking tours, Segway tours, downhill mountain biking. You know, that's what we do. We're at $50 million in ARR, growing at over 100% year over year. And we've kind of done it with a lot of hard work, a lot of sweat. And, you know, we've had inbound requests from, 25 different VCs and PE firms. Have a really interesting perspective, because I talk with a lot of founders, and a lot of times they'll say, can you help me write a business plan and, pitch the VCs? I think the first thing that any company should really always do is think about making a business that can scale themselves, and then worry about those sorts of things later. But that's who I am.
Awesome. So that's the bootstrapped revenue, friends, family. Do you have any fools that gave you any money, or maybe don't want to highlight that?
I mean, there would have been fools if things had turned out a little differently, but hopefully we eliminated that last step
so far,
from the
so
category.
Good, right. Okay, awesome. And then let's hear a little bit from Sheila Narayan.
Hi, good afternoon, everyone. My name is Sheila Narayan. I am an angel investor. We are the kind investment folks. That's why we're called angels. I represent an organization called Golden Seeds. Golden Seeds is an angel investment network that invests in early stage companies. Our investment thesis is focused on investing in women-led companies. So we invest in companies that have a woman at the C level and owns at least 10% equity in the company. We are a hybrid investment group where we have individuals that invest, and that means they write their own checks. We also have a venture fund as well. We have about 300 members across the country, and we will get into this a little later, but we work with a number of different angel groups to syndicate deals. So that's who I am, and I look forward to telling you more about angel funding soon.
Awesome. And then Adam?
Hi, my name is Adam Balkin. I'm a managing director at a venture capital firm called General Catalyst that has its origins here in Boston, but has also expanded to both California and New York. I spend most of my time between Boston and New York, and focus primarily on companies that have a consumer focus, but also do some enterprise software investing too. So our firm has invested in some of the great Boston companies like Kayak and HubSpot, Demandware, more recently companies like Drift, and also a bunch of companies in California like Stripe and Snap, Airbnb, and in New York we have a growing portfolio of companies that include ClassPass, Warby Parker, Vroom, Oscar Health, and many others. Generally, what we do is we sort of have a wide aperture for investing. We do our smallest investments are done through Rough Draft Ventures, which is a student fund that invests $25,000 in companies that are being formed at colleges and business schools in Boston, New York, and everywhere in between, and then all the way up to Series A investments that are $5 to $10 million, some seed investments that are $500,000 or $1 million, and we also do growth equity where we try and find companies like Max's company that have bootstrapped successfully and are looking for like much later stage capital, and there we could invest between $20 and $50 million. So we have a very broad focus, and look forward to talking to you and sharing some insights.
Great, and I am John Harthorn. I'm the founder CEO of Mass Challenge. Mass Challenge is the largest startup accelerator in the world and the most startup-friendly accelerator in the world. We're structured as a nonprofit, and we don't take any equity or anything from the startups that we support. We use a competition model. We give away over $1 million of cash prizes in Boston and over $2 million around the world annually to the world's best startups, the highest impact, highest potential startups. Anybody can apply from anywhere in the world with any startup in any industry, and then we use crowdsource our judges. We have several on the panel here that have acted as judges and mentors for our teams. So we get experts from the community to judge those applications, identify the best, and then we take 128 in Boston that get 4 months of free acceleration support, office space, manufacturing equipment, wet lab space, all sorts of good stuff, and a lot of intensive mentorship, training, et cetera. At the end of the 4 months, we have a final round of judging, determines the winners, and they split the $1.5 million of cash prizes this year in Boston and other amounts around the world. So that's what we do. This is our 8th year. We've graduated 1,211 startups in the last 8 years. They've raised over $2 billion of outside capital and generated over $900 million of revenue. So that is a interesting and unique form of startup funding, is the accelerator model. We're unique in that we don't take equity. More typically, accelerators are run by investors, and they will give you between $50,000 and $150,000 or so of capital up front to each of the startups that they support in return for typically around 6% equity from the startup. And that Y Combinator really pioneered that model, started it in Boston, brought it to California. You also have Techstars, 500 startups, and a number of other great accelerator programs out there. And that can be now a real badge of approval if you get accepted into one of these accelerators, and that can lead to further angel investment or venture investment, et cetera. So with that, let me just take a run through each of you guys again in sequence and just maybe talk us through the process for each of your types of investment and sort of which types of startups is it well suited for. Like for you, Max, what made you decide not to go after venture funding or angel investment? And then what do? You just call an uncle and say, hey, I need $5,000, or how, like, did you provide a pitch deck? What's the process like?
Sure. I mean, I think the biggest thing is this model is only going to work for, I'd say, 8 of 10 different types of startups. If you are a highly capital-intensive company that's going to be like banking or some large, medical sort of thing, maybe this doesn't apply. But I really believe that maybe 8 out of 10 companies, you just start. Once you need the money, you'll try to find it. I talk with so many founders that are getting kind of decision paralysis on how to start their company because they're trying to figure out how to pitch it best to, General Catalyst. People are getting way ahead of themselves if they're thinking about VCs and sometimes even angel for 8 out of 10 companies. Just do it. I've talked with so many different founders, and there's so many different ways to start companies. Just pretend that there is no funding, and just go out and do it. If you're selling something and you need a big $20,000 marketing budget, why not just print something out on little postcards and go out, start selling it in Faneuil Hall, by yourself? I mean, there are ways. People come up to me all the time, and I can tell you how to start a company with zero money. Once you create problems for yourself, where as you start to scale, heck, I need some money, then worry about the funding. If you have a good business, you'll be able to find money anywhere. Once you have a good business that you need cash to support the scale, anyone will give you money. If you try to plan it out too early and kind of say, hey, here's how we're going to do it, please give us this money for an idea I want to do next month, either you're going to get totally beat up on the terms, or you'll never get the money and it'll just be, hey, I had an idea for a startup one time. So the reason we did it is we just kind of said, you know what, we're just going to do it. And we just started going, and
Yeah, there's a bunch of good tips in there. So one is no matter what type of funding you're ultimately going to seek, you want to reduce your costs as much as possible so that you don't need as much funding. It lowers your risks. It allows you to test the market early. So you want to get out there, try guerrilla sort of marketing tactics and sales tactics. You can often, if you can just push out your debt payments, like if you have a creditor, like a caterer that caters an event, just try to pay them in 90 days, not 30 days, and then try to collect payment for the event in 30 days, not 90 days. So you can often play with the timing of inbound money and outbound money to try to gain yourself a little bit of time or traction. The sooner you can start selling and getting revenue, the better for your business. And if you can figure out ways to do that cheaply, that's the best for you. That said, you also made a great point that doesn't work for all industries and all businesses. There are a lot of businesses for which you're going to need $100 million before you can even begin to sell your product. And so that's not going to be a path that works there. But for a lot of businesses, it does work, and just being scrappy and thoughtful and just going out and getting it done is a great technique. So Sheila, talk to us a little bit about angel investing. What's the process like? What's the typical deal size? Variations across maybe geographies or industries, or just tell us a little bit about how that all works.
Sure. First of all, can everybody hear over the sirens? Yeah? Okay, great. Let me just explain what angel investing is first, and maybe the difference between angels and VCs. Angels are writing their own checks. VCs are writing checks with other people's money. So it's a clear distinction. So you're either going to find two kinds of angels. They're individual angels that are high net worth individuals that are investing their own money or through a family office, or you're going to have individuals that have formed some sort of group or are part of a group, an angel investment group, such as Golden Seeds. And in the Boston area, there are over 20 angel groups. So if you are a high growth oriented company seeking funding, maybe the first stop after you've utilized friends and family, after you've bootstrapped or whatever, you might come to an angel group. And the process is typical with groups is there is an application process, there's a screening, and then you would pitch the angel group, and the members would decide if they're interested in moving that company forward and entering due diligence and evaluating the company, and a few that make it through will get a check. I think that the thing that's really important that I often tell entrepreneurs is it's all about networking. It's really important that you just don't apply. It's really important that you start to go to events, to meet the angels, meet VCs early in your process as a company, not when you need money, because it's a process. It takes time for those checks to get written, and it's really important while you're building the company, you establish those networks and those relationships. Golden Seeds invests, as I mentioned, in women-led companies. We don't have a particular sector that we focus on, but the sectors that we seem to go after, because we see a lot of women-led companies, are in life sciences and technology and some consumer packaged.
Yeah, great. And so also super helpful. I completely agree that so much of the startup industry, but definitely funding, is very relationship driven. If you think like these are very risky investments, it's very hard to predict the future of a market that doesn't even exist yet. There's a lot of hypothetical potential for a business, but also a huge amount of risk. And so really what you're doing is you're betting on the person or the people. And so it's hugely important that you get to know other people, that you demonstrate you're trustworthy, that you honor your promises, you deliver metrics on time. And as you start to build that trust, it becomes much easier to get funding. Also, back to something that Max said, is if you have a really good business, money will come find you. Right, so if you're already winning and generating revenue and you've got proof points that your customers love your product and that your team is really established and smart and you're hiring more people and you're growing, money will find you because that's a good investment. If you're pitching on nothing, on just promises, that's a lot harder to get a good deal out of any investor. But the only way possible is to have a really strong relationship and have that trust built up as an individual. So those are all really good things. And then did you highlight a little bit about Golden Seeds has also a specific mission of funding female entrepreneurs? There's a little bit of an echo for us up on stage, so I wasn't sure if I heard that part. Maybe talk about this, something also that a lot of angel groups will have a sort of specific focus areas or areas of interest, which is a little bit more unique from venture, where they might have vertical areas of focus, but angels also are, they're not institutions, right? They're people, so they have their own emotional contributions to their investment and mentorship that they bring to it as well.
Just to add on to that point, I think that one of the things is what I like doing as an angel, and many of my colleagues do, is we get very involved in the companies. Either we take a board seat in the company or we are informally mentoring the companies, either before they get the funding or after. So I think that's one of the distinctions, that angels are very actively involved in their investments. And like you also brought up another point, each angel group is going to have a different focus. Golden Seeds happens to focus on women-led companies. There's different groups that focus on health tech or med tech. It varies. And angels are typically investing in companies in their geographic area. Golden Seeds happens to be a national organization, so I might see a deal in Boston. It's available to my colleagues in Silicon Valley. But many of the groups here in Boston, they invest in companies that are really 2 hours from where they're headquartered. And that's because they want to be very involved in the companies and help them grow at this stage. We typically see companies that are raising about $250,000, $500,000 to up to $2 million. It's typically called seed investing or Series A. That's where our sweet spot is. And then as the companies grow, then we're going to turn them over to you, and hopefully you're going to fund those women-led companies and take them all the way.
Yep, so Adam, that's awesome, thank you. So Adam's at General Catalyst is one of the most storied, successful firms out there. You guys have been part of many, maybe most even, of the really successful firms in the Boston area in particular. So this is later stage, bigger dollars. Talk to us a little bit about, again, the process, the differences, and then kind of check size, and how long does it take for a startup from like sort of day zero to getting a check in their account, all that kind of, a little bit of the logistics.
Yeah, so we are primarily, we describe ourselves as an early stage venture capital firm, which means that our core business is to do the Series A round, which is the first sort of institutional round after the phases that have been described here today. And as a result of that, our most valued sources of opportunities often come referred by other entrepreneurs, angel investors, seed funds, folks like Golden Seed, that have worked with companies, have nurtured relationships to the point that they are ready to raise, $3, $5, $7, $10 million Series A round. And that's what we specialize in. As I said before, we also do some seed stage investing and some later stage investing, but we like to be the first sort of institutional check in a company and start working with the entrepreneur as early as possible to shape the company, shape the culture, shape the team, and build the business. So the way that folks generally get to us, a lot of it is relationship driven. People that have been referred to us by trusted sources, by our portfolio company founders. A lot of the companies that we back are referred to us by our existing companies. But we also do a lot of outward bound activity to find companies. So although many of the companies that we fund are folks that have found their way to us, we spend a lot of time thinking about the spaces that we're most interested in. It could be sort of online marketplaces, it could be fitness and well-being, it could be online insurance and the disruption going on there. And then we will try to learn as much as we can about all the players that are in the space, and then contact and cold call or get introduced to entrepreneurs the same way entrepreneurs try and get introduced to us. Some of the other stuff we do is even more sort of technical or data-driven, where we may even build some software-driven trackers that look for activity on social networks or analytics sites to try and figure out where there's movement or activity happening. We also watch and monitor the press very closely. Some level of publicity is often good for startups because it helps create awareness and chit-chat amongst the folks that are writing checks. Just one thing maybe to say about venture capital is that I guess this applies to financing in general, is when you're thinking about where you are in the development of your company and also what your goals are, it always makes sense to do some research and make sure that you're talking to investors that are aligned with what you're trying to do and where you're going. Because one of the issues that sometimes happens is, some of the big venture capital funds like us that have, a fund size of, $500 million plus. Our current fund size is actually $850 million. We have very funds like us, but not just us, but our competitors that raise those kind of funds. Generally, we're looking for companies that can get really big, really, really big, so that the returns that we generate from the investments have a meaningful impact on our investors, which are generally university endowments and nonprofits. So some of the opportunities, even if they have a lot of merit and are really well thought through, very compelling, in the underlying economics, compelling entrepreneurs, sometimes they just don't, they may not meet the objective just in terms of sheer potential size of the opportunity. But that doesn't mean it's a bad opportunity. It could be a cracking opportunity. And there may be other types of investors that have a different sort of objective for what the outcome would be. And I don't think it makes sense to tell the investors what you think they want to hear. I think it makes much more sense to figure out what you really want to do with your company and then figure out which investors are best suited to that.
Great. So then I want to go through one more time, and then I want to open it up for questions. So start preparing your questions. But maybe, so every type of funding or every choice around which type of funding to use has costs and benefits aside from just the funding, right? So this is a panel on funding, but with venture investment comes great advice and mentors and networks and prestige. So similarly, when you're getting revenue to fund your company, there's a lot of advantages to using revenue that teaches you a lot and gives you benefits. There's also some costs potentially to not having a big upfront chunk of cash, which makes it maybe more difficult to go and hire certain types of talent or to perform certain types of marketing. Can you talk to us a little bit about the sort of if you encountered any costs or major difficulties by not taking institutional funding, and then also what kind of benefits you think you got? And I'll ask the same question of you guys, and for the angel and venture stuff, maybe just talk a little bit about the deal structure. Like, what's a typical, if you can describe a typical deal exchange, like how much equity, or how do you calculate how much equity you're going to take in return for the funding? Not in great detail, but at a high level, just so people can get a grasp of that.
Yeah, I mean, quickly on the benefits of not taking money early is you build a really strong business. The goal isn't, I'm going to just get product market fit so that I can raise money. That should never be an end goal. The goal should always be building a good business. It's hard no matter what you do. We work with some of our competitors are largely VC-backed companies that took $60 million. Another one took $34 million. Both of them are out of business now because they didn't start with the foundation of building a strong business that can exist on its own. With not taking money early, it basically, the way I see it is, you need to get into outer space. VC, it can take you to, is the second stage rocket to take you to Jupiter if you need it. But you may find that you exit the stratosphere with so much acceleration you can do it yourself. Some of the difficulties, I'm not going to lie, is we don't have the padding. You know, when you're scaling really fast, we've been growing well in excess of 100% year over year. We've gone from 3 people to 180 people in 4 years. You know, cash flow can be tight. It can be stressful when, you know, hiring top talent in Boston. You know, we have to have a slideshow when we hire new talent in Boston to let people know, hey, there's 2 types of startups. There's the types of startups you see on the movies with the indoor grass and the nap pods and the swing sets and the catered lunches. And then there's the garage type companies, the Fair Harbors, the Apples, the Hewlett Packards that are, you know, kind of asshole and elbow kind of companies. We're trying to define a category. So we have to kind of, it's a little harder to hire. But, you know, I think what we gain is well worth it because now, like we've all been kind of saying, the funding will come to you if you build a good business. And I think the goal, again, should never be fundraising. It should be building a good business, and you will know when you need the money. You know, we've had, you know, $100 million term sheets kind of thrown across our desk, and we found ourselves kind of saying, well, what would we do with the money? It's like, we're growing as fast as we possibly can. If and when that time comes where, gosh, if I just had 100 million, I could quintuple to $5 billion in revenue overnight. I mean, that's the perfect time for that second stage rocket. But the key has to be, and I'll hammer this home again and again to anyone I talk to, build a good business. It'll force you to be disciplined in your unit economics. And what happens to a lot of companies is if they take that VC money really, really early, then they haven't built something that can scale nicely. And you know, I've talked with some CFOs that are dropping, they're half the size as and dropping $100,000 a month on food. And you can't walk that back. You can't stop giving $100,000 worth of food and lunches for your employees. Now, in terms of the difficulties, my employees, 180 people, are like, well, why do we have IKEA tables and why is our office kind of dumpy? If we're 10 times bigger than everyone else, it's a constant kind of discussion with our employees. So everyone knows what we're doing. We're on a mission. This is not about playing startup and having free candy bars in drawers. It's about dominating a category and leaving our mark on the business world. So
awesome, great, very well said. Sheila, maybe talk to us a little bit about like the cost of angel investment, sort of like what does a typical deal exchange look like, and then what are some of the corollary benefits of having angel investors that aside from just the money?
Well, starting a startup is very hard. Raising money is equally difficult. It's not an easy process. A lot of the companies that we see are coming in early and they're pre-revenue. Sometimes they have are just developing a prototype. So a lot of the advice that we give early people, you know, is try to get money through bootstrapping, and as you get further along in the process, come back and see us. We will invest in companies that are very early. We typically are looking to a favorable valuation, so that means what's the value of the company, and typically if we're going to invest in the seed round, we want to at least take 20 to 30% of the company, and that's a negotiation between the angel group and the entrepreneur. And you have to decide if you want to give up that much of your equity of your company at this stage, or do you want to try to bootstrap it and move forward in the process. The more value you will retain if you have revenues, if you have a clear path to growth, if you have built a prototype that's been tested, and this will all depend on what sector that you're in. If you're a life sciences company, it's going to take a lot more money to commercialize a drug or a med device. If you're a consumer package company, we'd like to typically see revenues for that consumer package company. If you're a tech company, we want to see proof of concept with that technology, with early customers' interests.
Great. And Adam, you want to also similarly talk to us about maybe if there's a kind of a typical deal in terms of equity exchange at say, Series A, and then also what are some of the other values that you bring to the table from GC for startups in addition to the funding?
Yeah, so we, you know, if you look at the, I mean, there's a lot of flexibility and variability in how we invest and do business. At the very early stage, you know, with Rough Draft Ventures, where we give students $25,000, we take very little, the minuscule levels of equity. For seed investments of $500,000 to $1 million, we are also usually a little bit more flexible. And it sort of depends on what the dynamics are in the round and who else is involved and what the angel investors or the seed funds want to do. On the Series A investments is where we are sort of most focused on equity ownership, because typically we're not just writing a check, but we are really leaning into the company, joining the board, becoming involved, using all of our firm's resources to try to help the companies. And we're generally looking for around 20%, which means that depending on the round size, in that round, the founders are generally going to be diluting about 30% if you include possible co-investors and existing investors that are putting in additional money. So in a financing of, say, think of a $6 or $8 million financing at around a $15 to $20 million valuation is generally, sort of an example or a reasonable ballpark of where some of the Series A investments happen. They used to happen at much lower valuations, 10 years ago, but the markets are very frothy, and entrepreneurs have a lot of choice because, I think if you look at the funding environment today, I don't think there has been a better time in the history of humanity to be an entrepreneur and start a company. There are literally hundreds, if not thousands, of seed funds. There are hundreds of Series A funds. So if you are an entrepreneur that is getting traction and has created a sort of aura of success and interest around your company, oftentimes the terms are being set by you rather than us.
Great. All right, let's open it up for some questions. We're gonna have to struggle a little bit with acoustics, I think. Any questions out there in the audience? We got one right up here up front, and then there's another one over here after that. Sorry, I couldn't hear you.
How do you feel about convertible notes?
Convertible notes. Is somebody, you
So
both?
I'm happy to answer. So I feel pretty good about convertible notes because I think they are a source of great efficiency if used correctly. So the way that I think convertible notes make sense is for pre-seed, seed financing rounds. It often avoids a lot of the complexity and legal fees associated with doing priced rounds that require a new set of documents, shareholders agreements, investment agreements, and essentially allows a company to raise money at different prices using the cap so that you can, after Series A financing, you can essentially do the legal documentation for 2, 3, 4 rounds of financing in one go, which saves a lot of time for entrepreneurs, for investors, and of course, legal fees. With that said, I think it makes sense for that reason. I generally prefer, I think we generally prefer having a price associated with any financing round. So these kind of convertible notes that have a sort of notional price associated with them, I think make more sense. The other time that convertible notes work out is if a company has raised a round of financing and is not ready to raise the next round, potentially as a way to create some more runway to hit the milestones and get to the point where they can raise a round on the kind of terms that he or she is excited about. And oftentimes existing investors or potential new investors can participate in that. So I think used right, good, but there are ways that these notes can be used in the wrong way, and that oftentimes catches up with everyone involved.
Good answer. Sheila, did you want to add something to that? Okay, that was a great answer. And then we had a second question up here in the front. Sorry, I'll just sort of go in order. I'll come right back to you next.
So from the bootstrapping approach, how did you recruit individuals to come on board, knowing that you had to keep your expenses low? What allowed you to attract them?
Yeah, so we actually, our initial salespeople, well, first of all the founders worked for nothing at the beginning. First employees coming on, so we had a little bit of revenue coming in. What I kind of think is, what we did is our initial salespeople, and it's actually the sales model we still have today. We're almost entirely commission-based. And the founders actually, and myself included, actually work to help them continue to close our initial deals. And it's almost like if you put yourself in a situation where I have no money, there are no other options, you just kind of figure it out. If you can get revenue going, if it's you, if you're alone, if you have a couple founders together, what someone great told me one time is, if you're gonna start a company, you gotta be able to put in 80, 90-hour weeks. So even if you're doing this on the side, you're working a 40-hour job, you should be able to work at least another 40 hours on your passion, develop some revenue. If that starts coming in, then you can start hiring people for basically our salespeople even today are paid minimum wage as a base salary. And the top person will make, I think, $400,000 a year. So it works out. It's hard to attract college graduates from Boston, people going to BC, Brown, making minimum wage. But that's why I really believe that there are no silver bullets. There's no panacea here that, if I only had $100 million, I could hire all the top talent. Well, then you only know how to hire people at $120K a year using a recruiter, and then your unit economics are kind of tough when you try to scale to 500, 1,000 people. So what we did is, it was basically just minimum wage with a very high commission upside, and then we did everything in our power to make those initial salespeople rich as heck, and that became part of our culture. And now, we have virtually zero churn in the sales team. Out of 180 people, 50 of them, I believe, are salespeople today. And even today, at our size, it's the exact same model. And if you put yourself through the lens that I gotta figure this out with zero cash, you will set up really strong unit economics.
I would second that. We're a nonprofit, so we also have had to be very scrappy. We don't have equity to offer employees. We don't have this massive pool of funding to go tap into. Especially in the early years, it was really scrappy. And one of the advantages you have is that if you have $0, you enter a negotiation without the ability to pay. So you can't negotiate badly because you have nothing to offer. So we got office space for free, we get furniture donated to us for free. We became really good at finding free stuff to keep our costs really low. And that scrappy mentality is still part of our culture today, even though we now are much better funded because we're more established and have built up a long list of sponsors and donors. But we still know you can go get that stuff for free, why pay for it? And so you keep all your costs down, and then you pay the people, you pay for the people and things that are really critical. You identify your priorities really well. And then if you're mission driven, it's a much better motivator for people. Money's not actually the best motivator for people. It's a good motivator, but it's not the best one. Because if you're using that as your primary motivator, you're gonna attract people that want money, that aren't there for you, but are there for money, and they'll leave you for more money anytime. But if you attract them based on their values and their mission is aligned with yours, they'll stay with you even when there is no money, right? And then you'll make lots of money together, hopefully, and I think that's usually does work out if you have that genuineness and that sincerity. So it is tricky, though. One more question back here.
Yeah, in regards to the convertible notes, what's your thought on the safe rounds?
Yeah, this is a great question. I'd love to do this. Sheila, maybe you can start, and then if Adam wants to add.
So just so everybody knows what SAFE is, the SAFE is a type of convertible note that was created by an accelerator program like Combinator on the West Coast. We see it in the Boston area, but it's a lot more used on the West Coast. Pros and cons to it. I've never invested in a SAFE. That's just personal preference. I don't know if you have any preference on it. I think that it's very entrepreneur friendly. It's very easy to do. It's 2 pages typically. I think that the biggest challenge from an investor is you can rack up all these safes and there's no end game. So from an investor, I don't necessarily like them, but they're definitely used. If they're used appropriately, they could be a great way to get a company started.
Adam, does that make sense? Anything else to add?
Yeah, I think I answered it with the previous answer, because a SAFE is just a very simple way to do a convertible note.
Great. Any other questions? Looks like there's one over here on the. Oh, sorry. She's already over here.
Hi. My question is basically to all of you. I'm in the process of trying to start up a business, and my biggest downfall has been trying to develop a business plan, because with other organizations such as Seeds, other type of incubator programs, I've been told that I have to have my business plan structured. So the initial concept has already been discussed and jotted down, but it's been a huge struggle for me to kind of create a forecast and numbers and put all of that into some type of structure. And how do you speak to that?
Just
would you
what
suggest?
is the business, really quick?
It's basically within the service industry. So something more within sales, but structured more around fashion and the service industry aspect of it.
So what I would say is, I mean, the business plan will be easy after you launch it. I would just start it, because I'm telling you, for every founder that you hear about, there's 100 people who had an idea that never got it going. And it's really hard to write a business plan when you don't know what it's going to be like. And what I see happen all the time is people like yourself spend hours and hours writing this business plan. You haven't been out in the street. You haven't talked with your customers. You haven't tried to hire people. Just go, just do it. And then after you've been doing it for a month or two, you got a little bit of traction. You know exactly, what's going to happen down the line. And then that business plan will come out like butter. You start working with Mass Challenge, then you get over to the seed round, and then once you're in the stratosphere, you're going with General Catalyst, and they'll take you to Jupiter. But I mean, you got to just do it, because I'm telling you, you will just be frozen writer's block trying to write that business plan until you just do it. And anyone who says you got to write that business plan first, I think that's conventional wisdom. I'd say just go out and do it. Just start that company.
Yeah, and I would say that it's not even conventional wisdom at this point to have to write a business plan at this stage. I mean, like, business plans are outdated at this point. I don't think we don't even see business plans from very early stage entrepreneurs. Essentially, what I think is much more valuable, as Max said, is to come back with show up to talk to an investor with a customer survey or some real insight that you have based on your experience that demonstrates that there's a market need for what you want to do, and explain how the underlying economic model could work just based on like a transaction. That we believe that customers will pay $7,000 to $10,000 a year for this kind of service, and we can provide that service based on this cost breakdown. But it's not about 5-year projections or 3-year projections, because the truth is, no one on this planet knows what 3 or 5 years out is going to look like. So it's much more about saying, if I was, if the person I'm talking to is a smart investor, what are the 3 or 4 things that I think she'll care about to believe in what I'm doing, and how do I show evidence around that? Have I built a prototype or a working product that they can touch it, feel it, see it, and can I put this down on a 5 or 10 page slide deck where I could tell the story in an animated and sort of fun, engaging way, and I would forget about business plans.
The only thing I will add to it is we are all very fortunate that we live in a city where there are literally hundreds of events every single day for entrepreneurs. So I would encourage you to take a look at what's available to you, because that can help you to figure out how to find customers, how to perfect a sales strategy. If you need assistance, there's a lot of things going on. And I will also give a plug at HUBweek for next week is Women Entrepreneurs Week here in Boston, right on the heels of it. There's a lot of activities that are going on that can help people advance their businesses, whether they're a super high growth company or a lifestyle normal growth company. There's a lot of resources here in Boston that are free that you can take advantage of to help you frame out your business pitch deck, or how to find a customer, how to create a sales strategy. All those things exist.
They're all excellent pieces of advice that I concur with. I would also add, we don't ask for business plans. Nobody really asks you for a business plan anymore. It's helpful to have maybe an executive summary or short form where you just structure your thoughts. But you can even, what I did as a helpful exercise when launching Mass Challenge was just write out sentences of the best case scenario outcome. Mass Challenge will become the largest, most successful accelerator in the world because we have access to the talent that we need to run the organization. We will be able to raise the money from, at the time we thought it was the federal government, which turned out not to be right, but you write out your hypothesis for how you're gonna solve all of the challenges or what people are gonna pay for it or why you're gonna develop the best product. And then you can go, we just started sharing that script with people and they would say, that's BS. There's no way you're raising that money from the federal government. And they would say, really, why not? And then we'd learn that they were right. And we'd say, okay, just flip it and say, we'll get it from the state government, right? And then you just keep changing, so it's a hypothesis. It's like the scientific method. And you go and you try to prove each point, and if you're proven wrong, it doesn't mean you're done. It means you just flip that sentence into something else, and then you keep going until all of the proof points come back positive, and then you're good. And I think to Max's point, this doesn't mean spend 6 months on it. This is something that we did over a month, and then we were already executing while we were telling the story, but just a way of structuring.
Yeah, one last thing to add is, honestly, I believe just chase revenue. Every time I think, should we write some stuff up? We have no actual materials because every minute not spent chasing revenue, I think, is a wasted minute. I mean, we have integrations with Expedia, TripAdvisor, meeting with all these big dogs, all these C-level people. They're like, can you give us your presentation? It's like, I mean, here's some cool numbers for you. If you chase revenue and really just charge on that, just follow that top line dollar, and everything else will just fall into place.
All right, we got 30 seconds left. I'm just gonna get the one very quick answer here.
Okay, I wanted to know if you have a company that has an international focus where the product is going to be made internationally, you're gonna have some personnel, internationally. What could be some of the considerations? And also, what isn't crowdfunding sort of like the way to go these days as opposed to these other ways of, funding?
You talking about a physical product? A physical product?
Yes.
All right, so if you're getting it made overseas, you can get that shipped in. Having international employees is a little tough. I'm assuming you're just going to contract someone to build something and ship it in? Okay, so in that case, don't worry about, internationalization of anything. Write up an RFP or a spec or something, get it shipped in, and crowdfunding is solid. I did that. I had a stupid little company called Morning Head that was on Shark Tank and went viral on, Kickstarter and stuff. It is good for physical products. What I would do is try to get a minimum viable product yourself, already kind of built out. Get that one thing shipped in. You can go on, I would use a US manufacturer first, and then once you're at scale, go internationally. Go to thomasnet.com, see all the US manufacturers. Get a manufacturer to build something for you for free. Pitch them that you can sell 10,000 of these things. Get volume pricing up to 100,000 units. Ask them to ship you 1 or 2 for free. Get those 1 or 2 for free. Make the Kickstarter. Have it go viral. And then after you, what I think hurts a lot of Kickstarter-backed companies is they do the Kickstarter and do this video before they even have a prototype or an MVP. Get that MVP made. It might cost you $5 grand. Maybe you can get it done for free. Get it built by a US manufacturer, and then after you get the Kickstarter, work on mass production overseas to get the cost down if you need to. You may be able to do it in the US, and all of that's easier. You can travel much lighter. If you're trying to get something made in Shenzhen, you're gonna need someone on the ground over there. A lot of times you can do it here if it's a physical product. But yeah, Kickstarter or Indiegogo are solid for small physical products.
All right, we're gonna have to call it off here, but we'll stick around for a little bit and can answer questions individually after this. Let me just go down and just maybe any one last sort of word or sentence of input or thoughts on funding and advice for the crowd.
If you leave this talk and you're starting a company and you just say, yeah, but funding would just make everything easier. This is hard. Starting a company is the hardest thing you'll ever do. Funding should never be a safety net or a parachute. It should be a turbocharger and an accelerator. Build a good business, and you'll know when you need the money to help you with cash flow or whatever. Don't chase the dollar, because I hear so many people saying, oh, if I just had the money, it'd be easier. Well, my competitor has more money than me. We're beating every single competitor in our space. They've raised in excess of $100 million. It's about building a good business, chase revenue, and the money will come to you if and when you need it.
Great, Sheila?
I would say make sure when you're looking at fundraising, relationship building is key. And don't take it personally because you're going to hear a lot of no's, but you will get yeses.
Yeah, I would just say that if you are really interested in entrepreneurship, either start a company or go and work for a fabulous entrepreneur like Max, who can show you the road. Because this is any of this stuff, venture capital, entrepreneurship. It's apprentice type businesses, and the more you can learn from good people, the better off you are. And I would just think about any decisions you make around how can I surround myself with the best people that I can, learn the most, so that I'll be ready when I want to do it. But if you're ready now, then please go for it and come see any one of us. Thank you.
Great. All right. Thank you guys all so much for joining us.